So, we're going to dive into a multi-billion-dollar question that is seriously shaking up Wall Street. And that is, why are some tech giants being rewarded for their massive AI spending while others are getting absolutely punished?
Hey everyone, welcome to Byte-Sized Tech. Today, we are unpacking a really fascinating paradox that's playing out in the world of AI right now.
You know, it seems like a simple question, right? But the answer is super complicated. You've got these huge companies spending billions, literally billions, to build the future of AI. But for some, their stock prices are soaring, and for others, they are just getting hammered. So what's the deal? Why is the exact same strategy leading to such wildly different results? Let's break it all down.
To really get to the bottom of this, we're going to look at 5 key things. First, we'll talk about the just mind-boggling scale of this AI spending spree. Then, we'll dig into why Meta got punished by the market. After that, we'll see how Google pulled off this incredible high-wire act, and we'll even look at what's being called Microsoft's good problem. And finally, we'll wrap it all up with the new rulebook for investors in this AI era.
All right, first up, the AI spending spree. And when I say spree, I really mean it. This is a full-blown arms race for computing power, for data centers, and the price tags are almost hard to wrap your head around.
So let's just start with a number to put this all in perspective. Google announced that its capital expenditures, or CapEx, which is basically the money they spend on physical stuff like servers and data centers, is going to be somewhere between $91 and $93 billion. And just to be clear, that is not their revenue, that's just what they're spending on infrastructure. It's a massive, massive bet on their AI future.
Okay, now compare Google's very specific number to what Meta announced. They also promised a huge spending increase, but their language, it was way more vague. They just said their CapEx would be notably larger. No numbers, no ceiling, just a promise. And this tiny difference in how they communicated this is absolutely key, and you're going to see why in just a minute.
And you know, this isn't just a story about the huge tech giants. Even a company like Roblox is feeling this pressure. They saw this incredible 70% jump in daily active users, which is great, but that kind of growth requires gigantic investments in infrastructure and AI. So this tension, this tug of war between growth and cost, it's happening all across the industry. Which brings us to our next point.
So now, let's zoom in on how this all played out from Meta. This is really the heart of the mystery. Why on earth did investors react so badly to their plans to spend more money?
This really just lays it all out. On the left, you've got Meta's kind of fuzzy announcement, and on the right, the market's brutal reaction. Their stock just fell off a cliff. Investors basically heard more spending without any of the important details, and they hit the sell button. But why?
Well, analysts have a theory. They say that for a while, Meta had been in what's called a harvesting phase, basically raking in the profits from their past big investments. This new announcement signaled a big shift back into a much more uncertain investment mode, and that totally spooked the investors who'd gotten pretty comfortable with those steady profits.
So, what was the crucial thing missing from Meta's story? I mean, they told everyone they were going to spend a fortune, but they completely failed to answer the single most important follow-up question. What are we going to get for it? They gave no clear picture of what the revenue growth from these billions of dollars would actually look like.
And that leads us perfectly to our third section, Google's high-wire act. Because while Meta kind of stumbled off the tightrope, Google managed to walk it perfectly, balancing that massive spending with showing investors exactly what they were getting in return. And this, right here, is where Google just nailed it. They didn't just drop that $93 billion spending number. Oh no, they also showed investors the payoff. They reported that revenue from their AI products grew by over 200% from the year before. See, they didn't just show everyone the bill, they showed them the receipt.
Analyst Brent Phil had this fantastic analogy for it. He said, for a while, Google's AI stuff looked like a Toyota Camry from the outside. You know, reliable, but not super exciting. But with these results, they finally popped the hood and showed everyone they were hiding the biggest engine on the block. The tech underneath was always incredibly powerful, and now it was finally translating into real, measurable cash.
Now for our fourth section, let's look at another really interesting twist in this story, Microsoft's good problem. Microsoft also spent a ton, and their cloud growth numbers look solid, but the market's reaction was still kinda meh. The reason why is pretty fascinating.
This quote, coming from Microsoft's leadership, says everything you need to know. Their problem wasn't a lack of customers. The problem was that they literally could not build data centers fast enough to keep up with the overwhelming demand for their AI services. I mean, it's a problem for sure, but it is the best kind of problem to have.
So that 39% growth in their cloud service, Azure, that was really just the tip of the iceberg. The real story, the hidden number, was in their commercial bookings. These are the contracts they've already signed for future services. That number grew by an insane 111%. This backlog is proof positive that customers are just lining up around the block to spend money, even faster than Microsoft can build the capacity to take it. The demand is just completely off the charts.
Okay, let's pull all of these different threads together in our final section, the investor's playbook. What are the big lessons here? What does Wall Street now expect from companies who are in this high-stakes AI arms race?
It all really boils down to this one idea: narrative control. See, it's not enough anymore to just spend money. It's not even enough to just have great tech. You have to be able to control the story that you tell investors. You've got to provide them with clear proof of demand, a believable way you're going to make money, and a quantifiable return on all that cash you're spending.
This table just lays it out so clearly. You've got Meta with their vague promise and absolutely no proof of a return. Then there's Google with a very specific spending number and that concrete 200% growth to back it up. And finally, you have Microsoft, justifying their high spending with that insane backlog. 3 companies, 3 very different stories, and the market reacted to each one.
So, the new playbook for any company in the AI race is pretty simple. Step 1, you have to announce that you're spending a massive amount of money. That's just the price of admission now. But step 2 is crucial. You have to immediately show clear evidence that the demand is real. And then step 3, you have to connect the dots for Wall Street and show them a direct, measurable return on that investment.
So, if you take away just one thing from all of this, let it be this: the era of just selling the dream of AI, it's over. In this new phase of the AI arms race, investors are demanding to see the receipts. They want cold, hard proof that these billion-dollar gambles are actually going to pay off.
And that kind of leaves us with one final thought to chew on. In this modern AI gold rush, it's becoming really important to ask, who's actually selling the shovels? You know, the tools and platforms that make real money, and who's just spending billions digging for gold with absolutely no guarantee they're ever going to strike it rich?
If you found this explainer useful, we'd love it if you'd like, share, and subscribe to Byte-Sized Tech for more deep dives into the world of technology. Thanks so much for watching.